You take that personal loan, and then you're able to, now that gives you negotiating power because now you have liquid cash, okay? And so you could essentially start calling some of these places, and you'd be surprised. Everybody typically is open to some type of settlement. We're talking sometimes with auto loans, especially with bad debt. So if you have some credit card debt, even if it's a charge off or collection, you'd be surprised because now that you can pay today and it's liquid, like, well, of course you can pay instantly because you can do that now, that now gives you. In this video, we're going to talk to you all about how personal loans can help you improve your credit score. Let's get right into it. So let's go over some things that we're going to cover inside of this video. So in this video, we're going to show you all how personal loans, using them strategically, can improve your credit score. Also, how personal loans can impact your credit score overall, including factors like payment history and, of course, your credit mix. And so by credit mix, the short version of this is that usually when you're building your credit, we always think about just revolving, which is, of course, credit cards, things of that sort, right? But people forget about the installment side. So that's anything that ends in the word loan: mortgage loan, student loan, auto loan, right? And of course, a personal loan, okay? So either way, we also going to go over some potential pitfalls to avoid as well. We'll touch on those. Also, we're going to go over how consolidating credit card debt, but not just credit card debt, with a personal loan can also help you improve your credit utilization ratio. Let's get started. By the way, if you're looking to get a custom game plan to help you improve your credit score, we can help you. We can help you qualify for homeownership and also qualify to lower your car payment as well too. This is one of our success stories here. Scan our QR code or click the link in the description below to learn more. So first, what credit score do you need for a personal loan to get approved for one? Now, typically you need about a 600 or higher, okay? The higher, the better. Now, have I seen people get approved if the credit score is a little bit lower? Absolutely, okay? However, you want to make sure that if you do have a lower score, that you have some other factors as well too. And of course, another question is going to be asked is, how is your, what made your credit score so low? Like, for example, is it the credit card debt that you're trying to consolidate? So they take that into consideration as well too, because there are loans for people that have credit scores under 600s, companies like One Main Financial, etc. But interest rates are going to be higher and numbers may not make sense at all. Okay. Now, keep in mind, if you do find yourself getting a certain type of personal loan and you just don't like the interest rate, regardless of what your credit score was when you got approved, you can always refinance the loan as well. Sometimes you could refinance it with the bank that you actually got the personal loan from. These are rare occasions. Sometimes they'll say it's a refinance when really it's not. It's a new loan with worse terms, okay? And they end up just giving you a new loan and they roll that one in. The whole purpose is, let's say, for example, you take out a $5,000 loan. You've paid it down to $3,500. A true refinance will be getting the $3,500 at better terms. That's the whole point of the loan, not essentially taking the $3,500 and then adding it to another loan. Technically, they're both new loans, but you're not trying to borrow more money unless the numbers make sense to you. But again, we're not trying to get into more debt. We want to actually take this and actually consolidate it and make the numbers better for the long term. Also, if you haven't done so already, be sure to like, share, and subscribe. Now, what are some things you can do with personal loans? Okay, now this is what you can do with personal loans to actually improve your credit score. Number one is going to be debt consolidation. So debt consolidation is essentially when you're taking all of your debts. It doesn't have to be a specific debt, but you're taking your debts in general and you're adding them up. And let's say, for example, you add up your debts, a mix between credit cards, personal loans, collections, whatever that debt is. Let's say it's $4,000. Then you would want to take out a personal loan for that amount of money. And then that way owing the money. But a lot of people don't know that you can do a debt settlement even if your credit is good, even if you have a good relationship with them. Trust me, banks want their money back, but they rather have it paid over time so they can make money off of that interest. Okay. But at the same time, some banks are open to doing a settlement, but usually this is also going to require you to close the account. So that's the only drawback. But again, they're open to it as well. So even if you have good credit and you're saying, man, I just can't pay this credit card off, you could try to work something out just by calling them without a personal loan. But worst case scenario, now you have the personal loan and now you can pay a lump sum. So if you owe a credit card company, let's say $10,000, and you say, well, man, if I had 8,000, I would do this. You call them up and say, hey, can I just pay you guys 8,000 to be done with this account? You'd be surprised. They may say yes. A lot of banks right now are saying yes to 60%, 70%, 80%, 90% of the balance. So anything that you can save, especially for a card that you can't use because the balance is so close to the limit anyway, or you have the interest that's constantly being added, you'd be surprised. That'll put you in a very good position as well. You also have charge offs. Now, sometimes we have credit cards that have been closed out already, and some people are still making those payments, but the balances are too close to the limit, or you haven't started making payments at all. I know, of course, a lot of people would rather just have this stuff removed from their credit report. But again, you got to think about the future. What's your future relationship going to be with that bank? A lot of times people think, well, oh, let me just get something removed. Yeah, but it's the same banks. It's not like brand new banks are popping up every day. You have fintech type banks that do other products. But for the most part, if you're going to end up using these same banks, either for a mortgage or another purchase later down the line, it's best that you don't mess that relationship up. OK. And then, of course, collections. This really helps, especially if it's for like a pay for delete, for example. OK. And so because there are some collections that you may have and say, OK, if I had this amount of money, I would pay them. And they're saying, well, listen, if you pay us X, then we'll remove it from your credit report. So again, this gives you that liquid buying power because now you can act on the same day. You also have auto loan payoffs for better terms. So sometimes when you try to do an auto loan refinance, and by the way, I'm going to give you guys some personal loan options to choose from as well in a couple minutes. OK, but the auto loan payoff for better terms, this is when some people try to refinance their auto loan by getting an auto refinance loan, but it ends up getting denied for various reasons. Sometimes it's your credit score. Sometimes the car has too many miles. Sometimes the car, they don't like the year of the vehicle, not like it, but it may be, past their threshold from what they want to, do borrowing. And so sometimes people try to refinance and they say, you know what, forget about it. Again, another option is a personal loan. OK, sometimes the numbers make sense. For example, if your personal loan interest rate is at, let's say, 15%, some of you all may say, well, Calvin, that's extremely high. And it is, no, that's pretty high. It's double digits. So you obviously want to try your best to stay away from double digits, but watch where I'm going. But your auto loan is at 24%. So let's say you get a 6-year auto loan. It's at 24%. You've had it, it's a 6-year auto loan. You paid 2 years. You got 4 years left. You're still at 24%. Why not get a personal loan that's at 15%? It's going to help you save the money. OK, so again, you got to be looking at the long term. And if you're not sure, just check the numbers. See what ends up making sense. Take the monthly payment, multiply it by how many months the monthly payment is versus what the monthly payments are for whatever you're paying off. And whichever one is cheaper is going to be the best for you in the long run. That's always a great way to test that out. OK, then, of course, you have personal loan payoff for better terms. It's the same thing. Just because you take out a personal loan, you could, let's say, for example, you take out a personal loan for 15%, right? Just to pay off the other one, right? You again get another personal loan that ends up being at 8% because now your score is going higher, 8%, 5%, whatever that situation is. Do the calculation, see if the numbers make sense, and then go from there. Now, sometimes we hear people say, well, Calvin, it's almost paid off. If it's less than a year left or less than 6 months, you're probably not going to see that much of a difference. And you probably should just pay more than a minimum anyway. That's another thing you guys can do, too, if you're not so heavy on the personal loan side of things. But again, that's just another option. Now, these are some pitfalls that you want to try to avoid as well, too, when you're taking out a personal loan. OK, number one is taking out too much debt. Now, taking out too much debt can increase your debt to income ratio simply because, again, you're now adding to the debt. So let's say, for example, you have $5,000 worth of credit card debt. You get approved for a personal loan for $5,000. You say you're going to use the $5,000 to pay off the personal loan. Now you have a total of $10,000 in debt. OK, here's the problem. If you use that personal loan money for something else, that's where it ends up increasing your total debt amount. So for the first 30 days, your score may even drop, not because of DTI. DTI does not affect credit scores. It's more so the fact that you took out a loan in general. So it's a new account, it's fresh, and it doesn't have any on-time payments on it yet. Now, if you take that money, that $5,000 from the personal loan, and you pay off the accounts, you're going to be just fine. OK, number two, borrowing at high interest rates can make it harder to pay off loans, increasing your debt. This is where I was talking about making sure that the numbers make sense. OK, again, it's nothing wrong with the interest with the personal loan at 15, 18% if it's better than what you had prior to and the numbers make sense. The whole goal of this is to save money. You're going to be making a monthly payment anyway. It may as well be saving you the most amount of money possible. And so again, this is why some people say, well, no, don't do that. That sounds crazy. You're already stuck in a crazy contract. So you may as well get a better crazy contract. Okay. That's just, again, my take on it, and you're paying on it anyway. But again, do the math on your own. At the end of the day, you're going to pay somebody. So you may as well save the most amount of money that you can. Next would be obviously failure to pay down the loan or your credit card may reduce the benefits of even taking out the personal loan, because now you're using that money for something else. Don't do that. Or of course, taking out too much, that'll throw some things off as well. Also, let me know your thoughts on this video as well too. Your thoughts on personal loans, paying certain things off, consolidating. Let's talk about it in the comments.